The burn rate is on fire, a massive 217% spike, yet the price is barely moving. The core economic principle of supply and demand is being defied. Why is this massive deflationary event failing to ignite the Shiba Inu rocket? Whales are watching, and the market is confused. This is the ultimate supply shock mystery. Well, let me explain. Welcome to Dr. Crypto, your daily serving of Shiba. This is the spot for you if you're curious about anything related to Shiba. If you want to keep informed about all the latest news forecasts and stay ahead of the crypto industry, subscribe. To get more SHIB news, be sure to click the like button. Please note that by the time you see this video, some rates may have changed. Financial advice is not included in this video. The Shiba Inu ecosystem is currently presenting a profound paradox that is challenging the fundamental principles of crypto economics. The token's burn rate, a key deflationary metric, has recently surged by an astonishing 217% in the last 24 hours, with millions of tokens being permanently removed from circulation. In a market where reduced supply is expected to drive up demand and price, Shiba Inu price has remained largely stagnant, trading at approximately 879 units. This decoupling of the burn rate from the price action is the central mystery of the day, forcing analysts to look beyond simple supply and demand models. The current market context is one of cautious consolidation, with a market capitalization of approximately $5.16 billion and a 24-hour trading volume of approximately $241 million. The expectation is that a burn rate spike of this magnitude should be a powerful catalyst for a price rally. However, the price's failure to follow suggests that a more dominant force is at play, overriding the deflationary pressure. This background sets the stage for a deep dive into the reasons behind this decoupling, focusing on the sheer size of the circulating supply and the current technical resistance that is blocking the price from reacting to the massive burn. The main event today is the dramatic spike in the Shiba Inu burn rate, which has increased by 217% in the last 24 hours, according to community trackers. This means that millions of tokens have been sent to dead wallets, permanently reducing the circulating supply. This event is a clear demonstration of the community's commitment to the deflationary mechanism, which is designed to increase the scarcity and, theoretically, the value of the remaining tokens. However, the critical counter-event is the price's muted reaction. Despite the massive burn, the price has only seen minor fluctuations, failing to break through key resistance levels. This lack of correlation is what is driving the current market discussion. The reason for this decoupling lies in the sheer scale of the circulating supply. While millions of tokens were burned, the total circulating supply of Shiba Inu is still approximately 589 trillion tokens. Analysts note that while a 217% spike is impressive in percentage terms, the absolute number of tokens burned is still a minuscule fraction of the total supply. This massive supply acts as a heavy anchor, requiring not just a spike, but a sustained multi-month campaign of massive burns to create a noticeable supply shock that would directly impact the price. The market's reaction to the burn rate spike has been one of initial excitement, followed by disappointment as the price failed to react. The price of Shiba Inu is currently trading at approximately 879 units, reflecting a slight dip in the last 24 hours, a clear sign that the burn rate alone is not enough to overcome the current selling pressure. The 24-hour trading volume remains robust at approximately $241 million, indicating that the market is actively trading the volatility, but the buying pressure is not strong enough to sustain a rally. The key market insight is that the burn rate is currently being viewed as a long-term fundamental metric rather than a short-term price catalyst. The market is effectively saying that the deflationary event is positive for the long-term health of the ecosystem, but it is not a strong enough force to break the current technical resistance. Furthermore, the price is being held down by the broader market sentiment and the massive circulating supply. Analysts note that the price's failure to follow the burn rate is a direct result of the token's historical price action, which has seen massive burn rate spikes in the past with minimal price impact. This suggests that the market has become desensitized to short-term burn spikes and is waiting for a more significant, sustained reduction in the circulating supply before reacting with a major price rally. The on-chain and technical evidence clearly illustrates the scale of the challenge facing the burn mechanism. The on-chain data confirms the massive circulating supply of approximately 589 trillion tokens. To put this into perspective, even a 217% spike in the burn rate, which removed millions of tokens, is still not enough to make a significant dent in the total supply. Analysts estimate that at the current burn rate, it would take decades to create a true supply shock that would directly impact the price. Technically, the price is being held down by a major resistance level. The price action is currently in a state of high tension, with a bearish death cross on the 4-hour chart being challenged by a bullish golden cross on the hourly chart. The death cross, a medium-term bearish signal, is currently exerting a stronger influence, overriding the short-term bullish momentum that the burn rate spike should have created. However, a powerful counter-narrative is emerging in the form of a bullish divergence, highlighted by prominent crypto analyst Javon Marks. This divergence suggests that despite the price's failure to react to the burn rate, the underlying momentum indicators are showing increasing strength, a classic sign that the selling pressure is exhausting and a major reversal is imminent. The technical evidence suggests that the price is coiled and ready for a major move, but the massive supply is acting as a heavy anchor, requiring a stronger catalyst than a short-term burn spike. The analysis of the burn rate paradox points to a critical implication. The burn mechanism in its current form, is a long-term deflationary tool, not a short-term price catalyst. Expert commentary suggests that the market has learned to differentiate between a short-term burn spike and a sustained, massive reduction in supply. The primary implication is that investors should view the burn rate as a positive fundamental metric for the long-term health of the ecosystem, but not as a trigger for immediate price action. Potential outcomes are being discussed with a focus on the need for a more aggressive, sustained burn mechanism. Analysts note that for the burn rate to directly impact the price, the total number of tokens burned must increase dramatically, potentially through a more efficient, automated system integrated into the Shibarium Layer 2 solution. Sources suggest that the price's failure to follow the burn rate is a temporary phenomenon that will be resolved when the bullish divergence plays out, potentially leading to an over 234% recovery. The analysis suggests that the burn rate is a necessary but not sufficient condition for a major price rally, and the market is waiting for a more significant catalyst to overcome the massive circulating supply. The Shiba Inu community, the Shib army, is highly engaged in the burn rate discussion, with social media platforms buzzing with theories on why the price is not reacting. The general sentiment is one of frustration, but also a renewed commitment to the deflationary mechanism. Community trackers show that the community is actively promoting the use of the burn portal and other burn-related initiatives to increase the total number of tokens removed from circulation. Developer reactions continue to focus on utility and the long-term vision of the ecosystem. The recent spike in the burn rate is a direct result of the ecosystem's ongoing efforts to reduce the circulating supply, and the developers are aware of the community's desire for a more aggressive burn mechanism. Sources suggest that the official Shiba Inu team is actively working on a more efficient, automated burn system that will be integrated into the Shibarium Layer 2 solution. This suggests that the developers are aware of the burn rate paradox and are actively working on a solution that will allow the deflationary mechanism to have a more direct impact on the price. This combination of grassroots commitment and official development efforts creates a powerful narrative that is focused on the long-term health of the ecosystem. The forecast for Shiba Inu is a near-term breakout, but it will be driven by technical factors and market sentiment, not the short-term burn rate spike. Short-term, 1 week, 1 month. The immediate watch point is the price's reaction to the bullish divergence. If the price can break the 1,000-unit resistance, the rally will be confirmed, and the burn rate will be viewed as a positive tailwind. Investors should watch for a significant increase in trading volume above the $240 million mark, which will confirm the strength of the breakout. Long-term, 3 months, 3 years, the forecast is highly bullish, contingent on the successful implementation of a more aggressive, automated burn mechanism. The long-term target remains the 3,200 unit range, a move that would represent a 234% recovery from current levels, driven by the bullish divergence and the long-term deflationary pressure. The key long-term watch points are the official launch of the new automated burn system and the continued reduction of the circulating supply. The long-term forecast is that the burn rate will eventually have a direct impact on the price, but it will require a sustained, massive reduction in the circulating supply. A balanced opinion requires acknowledging the fundamental challenge posed by the massive circulating supply. The primary red flag is that the current burn rate, even with a 217% spike, is not enough to create a true supply shock that would directly impact the price. Analysts caution that investors should not view the burn rate as a short-term price catalyst, as this could lead to disappointment and premature selling. Neutral insights suggest that the burn rate is a positive fundamental metric for the long-term health of the ecosystem, but the price is currently being held down by the massive circulating supply and the current technical resistance. The most prudent approach is to view the burn rate as a necessary but not sufficient condition for a major price rally. The risk is that the market may become desensitized to burn rate spikes, leading to a loss of interest in the deflationary mechanism. Therefore, a cautious, data-driven approach is recommended, with a focus on the price's reaction to the key resistance and support levels, and the long-term reduction of the circulating supply. The charts are screaming, the burn rate is on fire, but the price is failing to follow. The massive circulating supply is the anchor, but the bullish divergence is the engine. This is the ultimate supply shock mystery that will define December. We are watching the data, tracking the burns, and waiting for the final breakout. Don't miss the next move. The day is over now. Remember to give it a big thumbs up. To see our most recent material, share it and subscribe to the channel.